Lehman Brothers' bankruptcy 10 years ago remains the largest Chapter 11 filing in U.S. history, with a loss of over $600 billion in assets.
But I wake up every single night thinking, what could I have done differently?
The investment bank was among the biggest casualties of the U.S. subprime housing crisis, which led to a corresponding rise in mortgage defaults and slashed the company's value by half.
The various major institutions were providing extra insurance should debt go under. Well, as we led up to it, it started becoming clear there was more insurance written than there was debt. And then some of that debt went bad, and as we now know, a lot of that debt had to do with subprime or bad mortgages.
Some wondered why the Federal Reserve allowed the investment bank to fail, even as it rescued insurance firms like AIG and mortgage giants Fannie Mae and Freddie Mac.
The thinking from Hank Paulson, who was the Treasury Secretary at the time, was that they didn't want to create a moral hazard where they didn't want the markets to think that the government was going to step in and bail everybody out.
The U.S. Federal Reserve moved quickly to prevent a larger catastrophe and came up with TARP, for Troubled Assets Relief Program, a $700 billion bailout fund. But the U.S. Congress thought the plan was too expensive, causing the Dow Jones Industrial Index to plummet nearly 800 points, a single-day drop that wiped out $1.2 trillion in market wealth. It was uncharted territory, says former Fed Chairman Ben Bernanke.
We went into one of the most complicated and consequential financial crises in human history with very little in the way of a playbook for thinking about how to address the crisis. U.S.
lawmakers came up with new regulations, passing the Dodd-Frank bill, which imposed tougher regulations on banks to prevent a future crisis.
One of it is really self-regulation. We're starting to see that happen with the banks and who they're lending money to and how they're lending money, and they're using a lot of analytics.
But along with new regulations and a new administration came the political pushback.
Even though there's a push to move parts of it back, you know, the basics of it are huge. Banks need to keep higher capital in reserve than they used to. That's all over the world.
Markets have stabilized since the 2008 freefall, but 10 years later, the key government players, Treasury Secretaries Hank Paulson and Tim Geithner, and former Federal Reserve Chair Ben Bernanke are back in Washington to convene a new round of discussions to examine the effects of the policies and actions they took in 2008, and to ask the question, could it happen again? Mariama Diallo, VOA News.
But a recession is a technical term defined by the National Bureau of Economic Research.